What are the rules for a reverse 1031 exchange? Welcome to the lesson on reverse 1031 exchange. In this session, we will explore the rules and requirements that govern reverse 1031 exchanges, as well as potential challenges you might face during the process. This lesson is designed to help you understand how to navigate a reverse exchange, ensuring compliance with regulation, and make informed decisions about your investment property. So what is the reverse exchange? We already covered that. Some of the key rules and requirements. First is completion within 180 days. So in terms of time frame, the entire reverse exchange must be completed within 180 calendar days from the initial closing of the replacement property. Second, this is also a strict deadline because missing this deadline can result in the transaction not qualify for a tax deferral under Section 1031, plus triggering capital gain taxes. The second thing is taxpayer consistency. So it has to be the same taxpayer. The entity that buys the replacement property must be the same entity that sells the relinquished property. For the entities involved, so this rule ensures that the tax deferral benefits are applied correctly to the same taxpayer. Third is related party rules. It's also concerned with disqualified person rules, right? So for the related party rules, transaction involving related parties or a disqualified person must adhere to Pacific Act regulation to prevent abuse of tax benefit. So avoiding pitfall, understand who qualify as a related party or disqualified person is crucial to avoid the exchange being invalidated by the IRS. The next thing is the property value requirement. If you want to avoid booth, the replacement property must be of equal or greater value than the relinquished property, which means that you use up all your money from the sale of the property. If you have any booth, it's going to give you some tax implication. So if the replacement property is of lesser value, so the difference will be considered booth, right? And then will be subject to capital gain tax. The fifth thing is the property usage. For non-primary residents, either the relinquished property nor the replacement property can be the primary resident of the taxpayer, which means you cannot. It have to be both used for investment purpose, which is to rent out. You cannot use it as your primary home. Both property must be held for investment or productive use as in a trade or a business. There are some potential challenges. So first is securing financing. So if the credit market condition is tight, obtaining a loan for a replacement property can be challenging. And also, if you have cash, right, you might have to use this as a cash transaction. The next thing is the double ownership. So if the relinquished property does not sell within 180 days, the taxpayer might end up owning two properties simultaneously, right? Because you cannot sell your property that you want to exchange out, your old property, then you're going to have the new property and the old property all at the same time. Now, if that happens, you have both properties, so you want to keep both, or you want to sell one and keep the other, or maybe trying to attempt another exchange. So you could do that, but you kind of ending up having two properties. The third thing is the transfer tax issue. So transferring title to and from the exchange of accommodation title holder, the EAT, might incur transfer taxes in some states. And also there's state variation. So some states recognize the EAT role as an agent of the taxpayer and do not assess a tax, while some states do. So it is important to consult with the qualified intermediary to understand the state-specific rules. The fourth thing is the qualified intermediary role. QI is important, right? Because they provide you with expert guidance, right? They're also in the advisory role. They help to ensure compliance with IRS and avoid any potential pitfall and tax issue. Of reverse 1031 exchange, it offers a flexible solution for investors looking to acquire replacement property while selling their relinquished assets. However, they come with strict rules and potential challenges as outlined above, right, that require you to be carefully plan the process and also make sure you have the expert guidance with you. So by understanding the requirement, you can successfully navigate the 1031 exchange. With that, let's move on to the next question.